Hey everybody, it's John Younger, Assisted Living Locators. Today, 5 minutes with Renee Coleman of CrossCountry Mortgage. Hey Renee.
Morning, John.
Hey, look, I know you from the reverse mortgage world. Tell us about the myths and magic of a reverse mortgage.
Absolutely. So we've all probably heard the term reverse mortgage, but I'm going to guess if you've heard it in the context of, oh my God, stay away, right? So that's my job, is to educate and let people know, sort of dispel those myths and let you know what the product is, how it works, and let you know that it really can be a good thing for people. So a reverse mortgage is a mortgage like any other mortgage out there, but what it is, it's specific to seniors that are 62 and older. And what it does is it accesses the equity that you have in your house, to be able to use that money any way that you need it. So think of it almost like an equity loan. You have an
Ah,
equity in your house and you go out and you take out an equity loan, and now you have that money and you can go do whatever you want with it, right? Same thing with a reverse mortgage. You go out and you have access to that equity, but the difference is you don't have to make a monthly mortgage payment. So the difference between an equity loan and a reverse mortgage is you don't have to make that monthly payment. So the way it works, the house has to be your primary residence. It can be a single family, a multifamily, a condo, a few more steps if it's a condo, but it is doable. So we take the equity in your house, whether you own your house outright or even if you have a small mortgage on it, as long as there's enough equity in the house to pay off that mortgage. So I'll give you an example. Let's say your house is worth $500,000. You can access around 50% of it. The amount of equity we let you take out is based on your age and the value of the house, and the interest rates. So, but it's roughly around 50%. So in my example, let's say your house is worth $500,000. We're going to let you access around 250,000 of that equity. Now, let's say you have a small mortgage on the house. Maybe you still owe 100,000 on that house. We're going to use a portion of that 250,000 to pay off that existing mortgage. So now you have no monthly mortgage payment, and that's the beauty of the reverse mortgage, is there is no monthly mortgage payment. Now, some of the myths that are out there that are associated with reverse mortgages are that people think the bank takes your house. You're signing the house over to the bank owns your house, and that's couldn't be further from the truth. So that's the biggest myth we hear out there. So this mortgage program is just like any other mortgage. John, do you have a mortgage on your house? I have a mortgage on my
yeah,
house. Do you still own your house, or does the bank own it?
bank
No,
owns
you
it.
own your house, right? But there's a lien on it, right?
Right,
The
the
bank has
lien,
a
yes.
lien on it. So if you sell it, that lien has to be paid off.
Okay, yeah, I didn't think about
Same
it that
exact
way.
thing with the
Yeah,
reverse.
yeah.
Yep. So you still own your house. You're still on the title. You're still on the deed. It's your house. The bank does not take your house. When that home is no longer your primary residence, whether you've sold the house, whether you've moved on to assisted living, nursing facility, or you've passed away, when that house is no longer your primary residence, the mortgage comes due. That's it. Bank doesn't take your house. Now, you still have property taxes and homeowners insurance that you still have to make payments on. If something should go south there, then yes, your house can be taken away from you, but not having to do with the reverse mortgage. Just if you don't pay your taxes, the town is going to put a lien on your house, right? And they're going to foreclose on your house. It's not the lender. Okay. So that's biggest myth. The other myth that we hear out there is um, it's taxable income, and it's not.
Okay.
As I said before, it's just like a regular mortgage equity loan that you might have on your house. It's not income, it's equity. You've taken equity out of the house. So we can set that up any way you like it. The most popular version that we have is a line of credit. So basically, in my example, where we have $250,000 that you can access of your $500,000 home. So we have 250,000 available. We put it in a line of credit for you. You can access it whenever you need it. We can also do a lump sum. If you want a lump sum and you just need the cash, maybe you're buying a second home somewhere, or maybe you're paying off, maybe all of your mortgage would eat up the entire 250. We can do that too. We can also do monthly payments, if you will, but it's payments to you. So rather than just having a lump sum sitting in a line of credit, we can send you money monthly if you want. Let's say I need $1,000 a month just to make ends meet, and I want to set that up as a recurring payment into my bank account. We can set it up that way. We can also do a combination of all of them. I need $20,000 to fix my roof. I want a line of credit and I want $1,000 a month. As long as the numbers work, we can do that. So we can set it up any way you need it, and you can change it anytime you want to also. If it's sitting there in a line of credit and you decide, you know what, I seem to be drawing, $1,000 a month anyways, let's just set it up as an automatic payment. We can do that too. So those are kind of the nice fun things about them that I like. The other myth, if you will, people think it's a last resort. I have no other source of income, and this is my last resort, and now I'm going to tap into the equity in my home. I actually teach this to financial advisors for retirement planning, tax planning purposes. If you use a reverse mortgage, I mentioned earlier that it's not income, it's not taxable income to you. If you use that in your tax planning, rather than, so let's say in a given year, you have a retirement account, and most of your retirement accounts are tied to the stock market, right? Well, if you're withdrawing money, let's say there's a bad year in the market, and you're taking money out of that fund to survive, to live on, but the market was kind of tough that year. Rather than taking your money out of your retirement fund for living expenses, take it out of the equity in your house that year. So two things happen. One, your retirement account gets to stay and maybe recover a little bit without withdrawing from it. Secondly, for tax planning purposes, in most cases, your retirement funds that you're withdrawing are taxable income to you. If you're taking it from your equity in your home, it's not taxable income. So it can be a real tool to be used throughout your retirement planning. And like I said, the funds can be used for anything that you want. You want to take a vacation? Great. You want to fix the roof? Great. You want to put your grandchildren through college? Great. You want to keep it in there and pay your property taxes every quarter? Perfect. You can use it any way you like. So
That's
those are kind
awesome,
of the bigger
Renee.
myths. Yeah. So it's kind of a neat program.
It is, and you did solve one myth for me personally.
Yeah.
I always thought the bank owned my house, and
Nope,
it's a
you
lien.
own it.
No, that's
You own
perfect.
it.
I feel much better now. I can go out and buy some paint and not worry so much about the house because it's my house.
It's your house. You can do whatever
Renee,
you want with it.
yeah, that's awesome. Hey, thanks for coming on today.
My pleasure.
What is the best way for people to get a hold of you if they're interested in reverse mortgage?
Yeah. Yep. So my website is www.teamreneecoleman.com. And my phone number is 978-737-7489. And you can typically reach me from 8 a.m. to 8 p.m.
Nice, nice. Renee Coleman, CrossCountry Mortgage, thanks for spending 5 minutes with us.
Thank you, John. I appreciate it.